What's up, guys? It's Cash Flow Cart. And today we are going to be going over, the most important metrics or statistics I like to look at when deciding whether to buy a stock. Obviously, there is a lot of options. There's a lot of different indicators, a lot of different metrics. So today we're going to keep it simple and we're just going to go through a few of my favorites. Let's get into it. Okay, so I've pulled up CocaCola, ticker KO, as an example for this video. Hopefully that works. And I'm going to be walking through, a couple different things I like to identify and use in my analysis of stocks. First up, this might seem fairly elementary, but net income, we want to identify an uptrend. So here we see Cokes. From December 2018 all the way to the trailing 12 months, that's a check. All right. We see 6.4 billion all the way to the trailing 12 months, 10.7 billion. It's not going to be perfect. There's other economic factors. Obviously, in the past 5 years, COVID has made some sort of, some companies have a little bit of lumpy revenue per se, but we want to identify that uptrend. So the first thing, net income growth. Next up, and I don't hear a lot of people mention this one. I really like to look at this, and that's the free cash flow per share. We're kind of looking for the same thing here, this uptrend. So we can see here December 2018 all the way to the trailing 12 months, we've seen the free cash flow per share increase from $1.43 to $2.35. And, you may ask, what is free cash flow? Basically, free cash flow is the cash a company has left over after normal operations, after operating expenses, capital expenditures. So essentially, free cash flow is cash that a company could put back on their balance sheet as cash. They could use to, reinvest in the company, or they could use it to pay dividends. Free cash flow, I would think of as like discretionary cash. And the reason why, sorry, my mouse is acting up. The reason why I like to use free cash flow per share here is because you're almost really killing two birds with one stone, in the sense that, this per share calculation is going to be, it says right here, total number of shares outstanding. Okay. So obviously we like to see when companies are buying back shares much more often than they're issuing new shares. And I really like to look at this free cash flow per share metric because it makes it simple. It puts it in terms of shares outstanding, which as a dividend investor, those are the shares that a company pays the dividends out on. Okay, moving on. I want to go over valuation too, but I think that's probably better to save till the end. I also like to look at profitability. Now, for profitability, I personally use net income margin, as my gauge of profitability. And this is going to take some discretion because obviously companies in different sectors are going to have, different determinations for what a good margin is. But one good way to think about it is if it's beating the sector median, if it's, stayed steady or improved compared to its 5-year average. And, essentially, if they have that margin, they have a little bit of leeway. Okay. So if something happens to Coke where they have a one-time expense or, sales aren't as good as projections, then they have a little bit of leeway. They're still going to be able to find that bottom line. And that's why I use net income margin. Moving right along. Like I said, I am a dividend investor. So, I obviously do like to look at dividend metrics. We'll look at dividend safety. And I like to think of this as the sustainability of that dividend. Okay. Is the company going to be able to continue paying that dividend, down the line? Do they have room based on their free cash flow, like we talked about, to continue to pay that dividend, but not only that, to increase that dividend? So for this metric, I like to look at the cash flow payout ratio on a trailing 12-month basis. For Coke, we can see it's 67. You'll see here the sector median is 41%. So Coke's is actually a bit higher. But, again, this is going to be something you're going to have to look at on a case by case basis, because Coke is obviously a very mature company. And as they generate more free cash flow year over year, hopefully they can keep that cash flow payout ratio relatively steady. So, that's a time where looking at the 5-year average can really help too. So for example, if we see this 5-year average is, okay, it's 70 in this case, and then we see the trailing 12-month is like 80, so it's like another 20% higher than it has been on average, then, that could be kind of a red flag, because that means, their dividend is eating up more and more of their payout ratio as they continue to increase it. It's something to keep in mind. But in terms of dividend safety, I definitely like to use the cash flow payout ratio. We'll come here to dividend growth. And, I do like to look at dividend growth in a company, but I will say this. I do think that, some YouTubers or some dividend investors, they do put too much of an emphasis on this metric, because, it's kind of one of those things that you have to see the full picture with. And just because a company has had, a great compound annual growth rate of the dividend for, 5 years, that doesn't mean it's going to stay at a similar pace for the next 5 years or the next 10 years. Whatever sort of time frame you're looking at. I think that some investors get too fired up and too excited, and they see a dividend growth rate and they're like, wow, perfect, this is the company I need. But in reality, you definitely need to analyze, the sustainability, the company's future growth prospects. And we're going to get into the economic moat of the company. So, sorry about my mouse. I'm not sure what it's acting up for, but okay, so there's a few statistics. Like I said, we're going to talk about the moat and the valuation. And I saw this thread, and I think it's a good segue into our section where we're going to talk about, what is an economic moat and why it's so attractive to a dividend biased investor. So this guy said, what stock to put $100 into today and going forward? And, obviously as dividend investors, we're thinking long term. At least in my case, in a perfect world, if a company gets added to my portfolio and I build out that position, I'm personally not selling. I'm enjoying that passive income. I'm enjoying that dividend growth. Like I said, that's a perfect world. Obviously, no investor is going to be perfect. But, if we're looking for these companies that we want in the portfolio long term, it's important that we also take into account an economic moat. And I think this term was coined by Warren Buffett. So essentially what an economic moat refers to is a company's ability to maintain their competitive advantage, for years down the line. I usually think of it as 20 plus years. So an example of that, we've talked about Coke. CocaCola has an economic moat, and that moat comes from, their brand loyalty, consumer preferences, and pricing power, and, ability to perform regardless of market conditions. Okay, so Coke is an example of a stock with a wide economic moat. If we think about something like Target, for example, which I see a lot of, dividend investors talking about, pretty regularly, Target doesn't classify as a wide economic moat because, It's a low cost industry to enter, and there's a lot of other, easily acceptable substitutions. Also, like in terms of groceries, they don't really have that consumer preference that something like Coke, which is a true just product and brand, could achieve. So Coke would be an example of a wide economic moat, and then Target would be an example of a company that does not have a wide economic moat. I like to buy companies with a wide economic moat, so I can hold them theoretically forever. I hope I'm not jumping around too much here. We're still on this topic, foremost statistics, but I wanted to throw in, that moat, that moat rant, I guess, because although that's not really a statistic that you can quantify in terms of numbers, it's more of a yes or no. Is it a wide moat or not? I still wanted to include it because it's definitely something I look for in a company, in the stages of deciding whether or not I want it in my portfolio. So now this question does say whether to buy. Okay, I've talked about this before on the channel, but I'm going to continue talking about it. You can love a company, it can be a great company. That doesn't necessarily mean the stock price is going to be fairly valued. It doesn't mean it's going to be a great opportunity to outperform. So, how do I determine if a company is fairly valued and if I want to add a company to my portfolio? I'll go into it. On the Seeking Alpha page, I'll go to valuation. I like to use price to cash flow. Okay. And just like I've been mentioning in a lot of different of these tabs, I like to compare the current to the 5-year, average or 5-year basis. So Coke's current price to cash flow on the trailing basis is 21.38 compared to, we'll call it 23 on the 5-year average. Just with that in mind, that could suggest 7%. Coke is 7% undervalued compared to where it's been in the past 5 years. And the reason why I like to compare, current numbers to a 5-year average rather than a 10-year average or something else, or like a sector median. The reason why I like to compare current numbers to that 5-year average is because, if I'm investing for 5 years, that's a good chunk of time. If I can find the best time to enter in a growing stock, within a 5-year time frame, for me, I'm happy with that. Okay? I'm not going to zoom out, look at some 10-year basis that might not even be as relevant, now, and try to time some perfect entry on a longer basis. I don't know. I like to look at the 5-year basis and try to find stocks that are like, I guess, a once in a 5-year opportunity, if that makes sense. And, a lot of guys will get on here and talk a lot about price to earnings. And the reason I don't put as much emphasis on PE when I'm thinking about valuation is due to the fact that, a company's earnings can be really choppy, and there can be a lot of one-time factors that can really affect their bottom line. So, when valuing a company, you're probably going to be better off using a different type of metric rather than earnings. And that's where, free cash flow comes in. We talked all about free cash flow today. It's very important. Okay, so just to summarize, what the foremost statistics you look at when determining whether to buy a stock, we went through free cash flow per share growth, net income growth, the free cash flow payout, whether or not a company has an economic moat, and then we went through, the valuation metrics. Okay, so there's 5 things that I personally like to look at. There's definitely other factors, but as you're beginning your journey or wherever you're at in your journey, you're going to realize that if you can kind of build this system, a system that works for you, 5 things or whatever it is that you can compare, that you can really familiarize yourself with, that's going to work a lot better in the long term than trying to think about, you know, what is the news? What's going to happen in 10 years? What's going to happen in the next election? Guys, at that point, it's going to be really difficult to have any sort of market outperformance if you're always just thinking about, kind of this noise in the background, trying to make your decisions off that. So I really like this question, and I hope my answer helped with those 5 measures I provided. The moat's not really a statistic, but I thought we needed to include it.